Hello traders, you are welcome back. Welcome back to my YouTube channel. In today's video, we shall be discussing one of the most important aspects of trading skills, which most people don't talk about: the risk management and the money management. In this video, we shall be looking into the relationship between risk management and money management. Also, we shall be looking into how risk management can help you grow your portfolio as a trader. And also, we shall be looking into money management principles and risk management principles, and also metrics for evaluating risk management and money management. So, traders, if this video is of best interest to you, do not hesitate to hit the subscribe button and also turn on your notification bell, so you'll be among the first people to always receive notification each time we release a new video. So stay tuned, guys. See you in the video. Welcome back, guys. A little introduction into the risk management and the money management as we progress. Now, it interests you to know that although risk management and money management are closely related, but they do have a distinct differences. Now, what is money management? Money management focuses on allocating and protecting capital. How an individual or organization allocates, protect, and utilize their capital, which is money. Money management also involves budgeting, saving, investing, spending, and tracking financial activities. This is in general terms. Money management's goal is to maximize profit and optimize the use of available funds. Now, what about risk management? Risk management focuses on identifying, assessing, and mitigating potential risk that could lead to financial losses or harm to an organization or an individual. So risk management also involves analyzing potential losses, developing strategy against those losses, and implementing control to prevent or reduce risk. This is very important, guys. Now, what is the goal of risk management? So the goal of risk management is to protect your asset, ensure business continuity, and improve decision making by minimizing potential harm. Please put that in mind. To protect assets, to ensure business continuity, especially this particular one is going to be helping us in trading business continuity, because if you do not manage your risk well, it can affect your capital and in the long run shut down your business. And as we know that forex trading is a business, so there is need to embrace the risk management, and we're going to be digging deep into all of these risk management factors in trading. So everything we have talked about in this introductory part is for general purposes. If you are doing a physical business or you are doing an online business, all these are supposed to be taken note of. So next, we shall be looking into risk management in trading. What is risk management in trading? Because that is why we are here. We want to know how to really manage our risk when we are trading. Very important. Let's proceed, guys. So trading assets always carry certain level of risk, whether they are low risk, e.g., talk about the treasury bill, the US treasury bill, or they are high risk, talk about cryptocurrencies. Most of us have the understanding of how volatile the crypto market is. Then you also have some volatile market in the forex market, volatile pairs in the forex market. So also the risk related to an asset class changes based on its characteristics, such as whether it's a world reserve asset or an exotic currency with low trading volume, as well as the market drivers affecting its value. So when we talk about market driver, we talk about the fundamental drive affecting that particular currency. So we said the risk related to an asset, for example, you're trading gold. So the risk related to an asset class changes based on its characteristics. So you cannot compare the characteristic of gold with the characteristic of US30, with the characteristic of Euro USD, and such as whether it's a world reserve asset or exotic pair. Of course, we have some exotic pairs in the market, especially in the forex market, like USDT RY. Most of us know about this pair. Turkish lira. This pair is actually a volatile and exotic pair. It's an exotic pair. So most people don't go for this kind of trading pair because they are so exotic and they cost more money to trade. So, which is very important. So most of these things are what we are going to be talking about, considering when you are trading. Very important. So risk management in trading involves analyzing the potential losses you could experience from a trade against the potential profit and adopting approaches to minimizing those losses, such as setting stop loss. Very important. So this is one of the risk management tools that we use in trading, that is your stop loss. Traders, do not forget, do not neglect this man, stop loss. Very, very important. Now also, holding losing position for too long is a common mistake for traders who do not have a robust risk-reward strategy in place. You do not want to hold onto your losses for too long. Very important. Take note of this, guys. But appropriate risk management sets limits on position size and accepted downside moves so that you exit a losing position and preserve capital for profitable trades in the future. Do not forget the goal of trading. The goal of trading is make money, protect money, and make money. Make money, protect money, and make money. So your capital is of utmost importance to you whenever you are trading. So you must guide your capital with all diligence, so you do not expose your capital to the global financial market. So let's quickly look into risk management principles. What are the principles we adopt when it comes to risk management? Now, the first is setting automatic orders. That is what we just discussed. So by setting automatic order, what we are doing is we are placing a stop loss order. You will exit a trade when price reaches a specific level, preventing further losses when an asset moves against your expectation, while taking profits to capture gains before the price turns around. So this is very important, guys. In trading, you will not be right 100% of the time. In fact, you might not be right 70% of the time, but you have to set a protective measure on your account so that you don't have your account jeopardized by carelessness. This is very important. Also, there is something we call hedging, which has to do with offsetting a position with a negatively correlated asset that tends to move in the opposite direction. Means you can still make money even when the initial position goes against you. So now this is very important, guys. There are some pairs that if you take them in the same direction, they can really affect your account. We call them negatively correlated assets. So assets like DXY and Euro USD. DXY and Euro USD are negatively correlated. What do we mean by this? It means that anytime DXY is actually going up, maybe DXY is buying, for example, we should expect Euro USD to fall because they are negatively correlated. So in the case that you are buying DXY and also you are buying Euro USD, that is a problem. So one of them will possibly be correct, one of them will possibly give you profit. So you can opt out of the one that is losing and stick on the one that is making you profit. Very simple, guy. So also, risk management principle involves diversifying your portfolio by allocating your money to different assets, markets, and time frames. You can avoid heavy losses in a single area and maximize potential profit. What are we saying in essence is you don't put all your money on one asset. You don't put all your capital on one asset. For example, if you are into provisions, you're selling provision, you own a provision store, you don't put all your money on just one product. You don't put all your money or your capital on one product. In case that product is not moving, it's going to tie down your capital and it's going to affect your business in the long run. So you need to diversify your portfolio. And of course, we know that the forex market gives us various opportunities on the different assets every day, each day. So you can allocate some portion of your money, possibly to Euro USD. Then, when you see another opportunity on Pounds USD, you have your money, you have the rest of your free margin to take the next position. That is what we are talking about. Diversifying your portfolio, very important. Now let's move into money management in trading. They are two different things. Money management, although it's very similar to risk management, but they are not the same. So unlike risk management, money management refers to a trader's overall strategy in allocating the capital they have available. How do you allocate your capital, the money you have available? Now, for example, I want to send this to every trader out there. In case you don't have this understanding, it is very important that you take this hook, line, and sinker. Now, if you are already on a trade, you put on a trade, let's say Euro USD, for example. Let's say you have $2,000. You have $2,000 in your account as your capital. $2,000 US. Now you place a trade on Euro USD, for example, Euro USD. So let's assume you have an opportunity to enter another trade. Then you have your free margin. After you enter Euro USD, let's say your free margin is now 1,900, for example, dollars. Your free margin is what the money available to take the next trade, not your equity and not your balance. This is very important. The money available to take the next trade will be on your free margin. So most traders make that mistake. Whenever they are currently on a trade, they see another opportunity to take the next trade. They base the risk on the equity or the capital. That is not what is going to be happening, guys. You have to base your risk or your money management now on the available free margin. That is why if you watch your MetaTrader 4, MetaTrader 5, when you are in a position, the only money that is not moving on your dashboard is the free margin. The free margin is there just for you to take the next trade, and that is when you are going to, that is the money you are going to place your risk on taking the next trade. That is very important, guys. So a solid money management strategy sets aside sufficient capital to allow for inevitable mistakes and losses on positions, ensuring that each loss is small relative to the overall size of the portfolio. Now, it also decides when to take profit on position and when to leave winning position to run to maximize gain. This is very important, guys. You are going to make mistakes. Even as professionals, we make mistakes. Nobody is too professional in this field. There are some silly mistakes you're going to make. For example, I've made a mistake of using, for example, I wanted to use 0.1 and mistakenly I pressed 1.0. So those are some silly mistakes you might possibly be facing. But you need to put something right. That is a solid money management strategy to set aside sufficient capital to allow for inevitable mistakes and losses on any position. So ensuring that each loss is small relative to overall size of your portfolio. You have $1,000, for example, and you are risking just $20, $10 on that capital. It's a very good one. So this is very important when we talk about money management. Very important. So you cannot rule this out. So next, we're going to be looking at money management principles. What are the principles we adopt in money management? So risking money you can afford to lose is the first one we should look into. When you came into trading, you possibly have heard that do not invest money that you cannot afford to lose. Now, that doesn't mean that the money you cannot afford to lose should be your capital. It can be a portion of your capital. So if I'm having $2,000 and the money I can afford to lose is a portion out of the $2,000. That is what we are talking about here. So it is important to make unemotional trading decision, which is less likely when you need the fund to pay for essentials. So you need to have this in mind, guys. So because when you over risk your account, it's going to affect you emotionally. But if you are risking minimal aspect of your account, you can easily let go of any loss. And having in mind that the next trade could possibly give you ×3 or ×4 of whatever you just lost. So this is how trading works, guys. So also, secondly, on money management principle, you have to find a way to limiting position size. How do you calculate your position? I will possibly going to be teaching us this thing, how to calculate your position size on this video. So as a rule, your average risk per trade should be no more than 2% of your account balance. In this way, you will still have funds available even after consecutive losses. This is how to protect your capital. Not more than 2%. Now, guys, this is interesting because if you are trading a prop firm, for example, if you are trading a prop firm of, let's say, $100,000, 100,000 US dollars. In this case, even to risk up to 1% is not advisable. $100,000 is a very big money, and you can actually risk 0.5% on each trade you take. Don't forget, trading is all about compounding. So if you try to compound your money, you're going to get something tangible out of it at the end of the day. So it's 0.5 per trade. And if your risk reward ratio is 1:3, which simply means that for every 1% you lost, you are targeting 3%. Now let's assume you win 10 trades out of 15. That 10 trade is actually 10 times 3. That's 30, right? So if you lose 5 trade, is 1 times 5, which is 5. So if you subtract, you are going to have net profit of 25%. That is how to compound your trading, your profit, guys. So what do I mean? If your risk reward ratio, analytically, your risk reward ratio is 1:3, and you took 15 different trades and you won 10 out of the 15 with 1:3, that 10 trades won is actually 30% because it is 10 times 3. Your risk reward 10 times 3, then you've just lost 5%. So 30 minus 5 is actually 25. You still come out net profitable. That is what we are talking about. So it is important to actually put this man in place. Position size, very important. Now next, also establishing a plan before starting. A well-defined trading plan that sets out entry and exit point and the amount to be risked will help you to avoid making impulsive decisions. This is very important, guys. So guys, I would like to quickly show us something on what I'm talking about here, especially this particular one, establishing a plan before starting. Okay, welcome back, guys. So this is just one of the stuff we are talking about. There is this trade that was placed on our Telegram channel on Euro USD, and our aim is to look for a short to sell this market. But we were waiting for price to actually get into our point of interest before looking for a sell to come down to this level. Now, what we mean by risk reward ratio that I just showed us is this. Look at this arena where I have my blue range, talks about our target. That's our profit level. Okay, let's call it profit level. That's our profit. And now look at our risk. Our risk is this red area. So if you look at this, is just like 1:2.5 or 1:3 risk reward ratio. So in this case, this is how we measure our risk reward ratio. We are risking a small portion to make a large portion, as we can see. So this is what risk reward ratio means. So in this market, what was the end of it at the end of the day? Everybody see what happened to Euro USD. So Euro USD actually played out the way we wanted it, and the way it is now is like we have won this trade. So guys, this is how you are possibly going to be measuring your own risk reward as well. So you need to set everything in place, that is the planning, before you actually take a trade. That's why we said establishing a plan before starting. A well-defined trading plan that sets out your entry and exit point and the amount to be risked will help you to avoid making impulsive decisions. This is very important, guys. So next, adjusting your strategy. A trading strategy that works for one type of asset may not work for another. So you will likely need to adopt different strategies over time depending on the market condition. Okay guys, there is this aspect I need to show you, aspect of risk management, especially on position sizing. As I promised, this particular one is very important. Now, every trader must know how to trade the right lot size per your account. If you have a $20,000 account, mind you, you will not be taking the same position size with somebody with $100,000 account. So you need to know what position is right for my trading. Now, and number one, this has to do with your technical skill. You must first measure your risk reward ratio. Now, what am I risking? Then, how many pips am I risking? Because that is the most important thing. So you have to first predetermine the number of pips you are willing to risk, which in turn is actually the money. Don't forget. So once you have determined that, then you can go into position size calculator to actually calculate what the lot size is supposed to be. Okay, so let me quickly show us that, guys. Okay guys, here is it, guys. So this is very important. If you are trading, make sure that you open this tab on your browser and just leave it there, because it is going to be very important to you. So just navigate to Google and type position size calculator. Very simple. Your position size calculator, as we can see here. After typing your position size calculator, go with the one that has my FX book. So you click on that particular one, then it brings you to this page as we have here. Now, what does this mean? Look at said position size calculator, which tells you how to calculate your position. So now the first thing you're going to see here is that it is asking us which currency pair are you trading, or do you want to trade. So that is the first thing. So for example, let's say we are going with Euro USD, then you can actually click this drop down button to see a whole lot of currency pairs that we have here. So you can choose any one of it. Even if you are trading gold, everything is here. So now it's now asking you, what is your account currency? Sometimes some people account might be on pounds, euro, or USD. So you need to choose your account currency. So let's assume our account currency is actually in dollars. Now it said account size. Now this account size talks about your balance. If you don't have any position opened, that is, you just want to take a trade for the first time, and let's say you now have $5,000. Now the risk ratio is asking you, what is your risk appetite? How much are you risking on these $5,000? Now if you say, okay, I'm risking just 1% on this, you put 1 here. Do not put more than 1 if you are risking 1%. Now you can also swap to money. If on $5,000 you want to risk $100, you can actually swap it with money in this case, but leave it as risk ratio is very important. So now, stop loss level in pips. This is very important. So you must have already predetermined your stop loss. For example, look at what we have here. Let's say I have already, before I take this trade right now, I've already predicted planned my stop loss. Let's say my stop loss is going to be, and my stop loss is around 25.8 pips. And look at my target. My target is around 100 pips. That's about 1:5. That is what we mean by risk reward ratio. The blue area here is my target. Why I'm risking just 25 pips and I'm to make 100 pips. That's about 1:5 if you divide 100 by 25. So this is what we are talking about. So when price gets here, I've already made 5% of my account. That's what we are talking about. So now already I have predetermined what my stop loss is going to be, and it is measured in pips. That's 25.8 pips. So I will still head on to the position size calculator and put 25.8 pips, or let's just say randomly 26 pips because of spread and the rest. So now you can click calculate. So if you click calculate, you see 1% or $5,000 is actually $50. So I am risking $50 here. That's the meaning. Now it's asking me, it's telling me that the unit I'm buying or I'm selling is 19,231. You know what this unit is talking about? That is the volume. If you look at it, for those of us that understand lot size, position sizing in trading, you will understand that standard lot is talking about standard mini lot and the rest. So 0.19 is what you're supposed to use. So now we know that 100,000 units is actually a standard lot. If you are trading a standard lot, is 100,000 units, which is actually 1.0 lot size. 1.0 lot size. So if you are trading 10,000 units, that's going to be a mini lot, right? 10,000 units, which is what? 0.1, sorry, 0.1. Then if you are trading 1,000 units, which is micro lot, that's going to be 0.01 lot size, as we know. But look at 0.19. What category does it fall into? So this is the category, because 0.1 to 0.9 is actually a mini lot, but this is 0.19, which is still part of mini lot. So this is very important. So last, you can see here, 19,231 will be the volume you are buying. That is the quantity you are buying or you are selling. So now, what is of utmost importance to us here is actually this particular one, 0.19, because that is what we are going to be using to target this 50%, to reach this $50, sorry. And also, like we said, our risk reward ratio has already been predetermined. That's 1:5. So that means if I'm losing $50, if I should win that trade, I'm going to be making 50 times 5. Yes, 50 times 5. So I'm going to be making about $250 US. Why actually risk 5 times 5 is 25? Yes. So why actually risk just $50? So this is how to calculate your position sizing. So make sure that this is actually open on ground before you start trading at all. You can see it's always on my tab. So each time I want to trade, I have to go down, calculate my risk first before I enter into any trade, guys. So this is how you're going to be doing your calculation as well. Okay guys, what are the metrics for evaluating risk management in trading? So the first metrics for evaluating risk management in trading is going to be our risk reward ratio. Like I just showed us on the chart, what risk reward ratio means. So this comes by analyzing the expected profit per trade compared with the amount of risk it involves. So you can decide whether taking a position is a viable option. You can also measure one potential trade against another to find the trade with highest potential. Of course, in trading, we take an A plus setup. That is a setup that is more reliable, that you prove or you see to be more reliable. For example, you analyze 3 pairs, Euro USD, Pounds USD, and Aussie USD, and you feel that Pounds USD is more reliable than any of the other two, then you can actually go with the Pounds USD. And also, your risk reward ratio is very, very important. Once you do your analysis, measure your risk in pips and also measure your target in pips. The difference between the two is actually the ratio we are talking about. So for example, if your risk is actually, let's say 10 pips, for example, PIPS, 10 pips, and your target, your T, is actually 50 pips. Now, see this is actually going to be 1:5. How do we get that? Just divide 50 by 10. That is all. So that is, your risk is 1%, because if you cancel this, you have 1:5 at the end of the day. So your risk reward, I think it's better we put the 10 at the top, 10 divided by 50. So 10 here is 1 and 10 here is actually 5. So which in turn is 1:5. So you are risking 1% to make 5%. If you win the trade, you've actually won 5%. That's what we are talking about. So you should always put this in place. So the ratio can vary, but in general, at least 1:3, which denotes the prospect of earning $3 from a $1 loss. So if you aim at losing $1 and you target $3, I think it's fair. So if you win like 10 trades, that is 3 times 10, that's about $30, mind you. So that is how it's going to be, guys. So I think that is considerable and acceptable enough. So the next metrics for evaluating risk management in trading is maximum drawdown. This is very important. What does drawdown mean? Drawdown talks about your floating loss before you come into profit, or the losses you've actually had on your account before you bounce back. Let's say you have $5,000 account initial deposit, but you've lost about $200. That $200 is actually your drawdown. So your drawdown can be on your capital, or it can be on your current position that you are in. So you must set a limit for maximum difference you prepare to accept between your highest account value and the value after consecutive losses. So you might decide that, okay, you do not want to have more than a drawdown of 10%. If you have a drawdown of 10%, you want to pause and reanalyze what is happening before you continue trading. So now it will interest you to know that you can easily reverse 10% drawdown with a gain of 11.1 to return to break even. To return to break even means to gain back your capital. So if you've lost 10% of the account, then when you make 11%, it means you have actually recovered the losses with about 1.1% on it. So your account is already back to the original state. That's what we are talking about. However, a 50% drawdown will require subsequent gains of 100% just to break even. So you do not want to have a drawdown as high as 50% drawdown on your account. It is detrimental, because before you can gain that 50% back, you have to do a lot of struggling. So that is why traders have to put risk management ahead of their trading, because what makes traders struggle in trading is the first series of losses they encounter in trading. Now, it has happened on several occasions that a trader started with a random loss size on, let me say, $1,000 account using 0.5, 1.5, and so on and so forth. All of a sudden, he lost about $500 on $1,000. So now he quickly realized that, he's using a random loss size. So he needs to now go back to the money management skill and start building up from the ground, now using a lower loss size. And that is what exactly he was supposed to do from the beginning of his trading. So put the right thing first. So the right thing first is put your risk management first. It is inevitable. You should not avoid it. Put it first. So it will keep you going. And imagine you driving a vehicle without brake. That is actually detrimental, and it's suicidal. So in the same vein, if you want to trade effectively, please guys, try to be disciplined enough to make sure you calculate your risk and you don't have so much drawdown that is going to affect your account in the long run. So the last metrics we are going to be talking about is win to loss ratio. The win to loss ratio measures the number of profitable trades compared with the number of unprofitable trades. Okay, for example, if you out of 10 trades you won 6 trades, that's a very good as a pass mark. So a ratio above 1 indicates that at least 50% of the trades were profitable. What do we mean by this? So if you divide 6 by 4, you should know that you're going to have more than 1%. So what do I mean? Out of 10 trades, you won 6 and you lost 4. So 6 divided by 4 is over 1 point something. So in this case now, it means that any ratio that's above 1, it indicates that at least 50% of the trades were profitable. So you can use the win to loss ratio to calculate the risk reward ratio. This is now based on your account growth, not your current trade you are in. So this one measures the growth of your account in the long run. So that is how it's going to be. So next and finally, guys, we are going to be looking into metrics for evaluating money management in trading. We've just talked about risk management. Now let's talk about money management. How do you measure the success of your money management strategy? Number one is account growth, which has to do with your equity curve. Your equity curve, when your equity curve starts rising in this manner, you should know that yes, your account is actually growing, which is very important. So consecutive gains can potentially increase the value of your account, but series of heavy losses will quickly hit into your balance. So this is very important. That is why you have to, this metrics helps you measure the success of your money management strategy or skill. So it really shows that yes, you have a good money management when your account is growing gradually, compounding. So also, analyzing the increase in your account value over time will indicate the effectiveness of your trading strategy and dictate whether you need to make adjustments to protect your capital. So if your account is still fluctuating, coming back, coming down, going up, coming down, going up in a zigzag manner, it means that there is something you need to actually fix right. There is something you need to fix right. So these metrics will help you measure the success of your money management strategy. And also average risk per trade. Yes, this is very important. So many traders determine the average risk they are prepared to take on each trade so that a single loss on a position account for only a small percentage of their account. So what do you mean by this? If you take the first trade and that trade hits deep into your account, you are yet to be a trader. You should take a trade that will not hit deep into your capital. At least for the first 10, 20 trades you are taking, it should not hit into your capital. Very important. Many traders determine the average risk they are prepared to take on each trade so that a single loss on a position account for only small percentage of the account. So a single loss on your position should account for only a small percentage of your balance. Very, very important, guys. So many traders makes a mistake of having series of losses on their account at first from the beginning, and that alone is detrimental, is discouraging. It will actually affect your emotion. So all of these are supposed to be put in place. So the general rule is to actually limit the amount to be traded per trade to 1 to 2% of the account balance. For example, if you have $1,000 portfolio, an average risk per trade of 2% will mean limiting trades to $20. So look at it, out of 1,000 you risk $20, and if your risk reward ratio is 1:3, it means if you win a trade, you are going to make 20 times 3, which is 60. So if you win 10 trades, that's 60 times 10, which is 600. So you are gradually increasing your portfolio. So guys, this is very important. So if you find this video very useful, guys. Please don't hesitate to hit the notification button and also subscribe to our YouTube channel so that you always be the first to receive the information about any of our newly uploaded video. And also there is a link to our Telegram channel on this video, so you can go click the link, join our Telegram channel to receive market update and also content like this. So stay tuned, guys.